Good morning. We're going to talk about the art of the deal. That's a very lofty subject. And we have two global deal makers with us, true global deal makers, Matt Olton and Steve Ingram. They're going to say a couple of words about themselves, and then we go straight to it because we have 20 minutes to see how much wisdom we can impart from them about global deal making. Steve, you want to start?
Thanks, David. Good morning, everyone. I'm Steve Ingram. I'm an audit partner at Deloitte. I started my career at Arthur Andersen. I was there for 16 years. I've been at Deloitte for 13 years. I head up our emerging growth company practice on the East Coast. So I split my time between the Boston area where I live, the New York area, and down in the greater Washington, D.C., McLean, Virginia. In that region, Deloitte works with over 200 venture-backed companies. We had 12 of our clients go public last year, and we see this year as being just as bright. So great to be here.
Thanks. Matt?
Thanks. My name is Matt Olton. I run EMC's corporate development group. That comprises EMC's global M&A activity. We are heavily involved in EMC's strategic investments and several related functions. EMC, if you don't know it, is a $52 billion New York Stock Exchange listed technology provider, global infrastructure provider. We've been very acquisitive, both in the US and in Israel, and some of the assets, some of the businesses that we are most proud of right now happen to have been acquisitions that we made in Israel within the last few years. And I'm sure we'll have a couple of comments about those.
Right. So we have, we're two service providers and one client, at least in our world, right? So let's start with the client. So Matt, how does EMC look at an acquisition? What are the special attributes it seeks, particularly when we're talking about a cross-border deal and in more particularity an Israeli deal?
Yep. So general comment, every acquisition that EMC has begins with strategy. And if we do not have a strategy to justify pursuing a target, we just won't do it. That's not to say that our strategies are perfect, and I don't think that they need to be perfect. But that is sort of the fundamental starting point for any transaction. Just, I guess, jumping ahead in the interest of time, one of the reasons that we've had a lot of success recently and in the past with Israeli businesses that we have combined with is that we have been able to identify very exciting enterprise-focused technologies, incredibly talented teams, ecosystems that permit us to develop larger businesses around those teams. And we've also found sort of common sets of values with the companies that we've engaged with in Israel. And when I say common sets of values, EMC prides itself on first and foremost, a sense of integrity, business integrity, a focus on customers, and a focus on execution. And the teams that we've worked with in Israel have shared those values almost without exception.
Is Israel a springboard for doing business from Israel into other countries?
So I guess there are two answers. For EMC, I think the answer is no, because EMC has such an established global presence. For young Israeli companies, the answer, I think, quite obviously is yes, right? Because Israel is sort of known to be a magnet of talented technical product offerings and so on. And so it's a very easy place from which to base a broad global presence, I think, for smaller companies.
Right. But technology from Israel, for example, that is done at the Israeli acquired level, will that be then sold by EMC worldwide?
Oh yeah. Oh, absolutely. Absolutely. I mean, we do not acquire businesses to be geographically focused,
or just to bring back to the United States,
or just to bring back to the United States. So let me give you a concrete example. In 2012, we acquired a company called Extreme.io, and I know that several people here are familiar with that company. At the time of acquisition, the company had 45 to 50 employees. It was pre-product, pre-revenue, but had some very exciting technology that we were interested in. We developed that technology with that team and grew the team quite extensively for 18 months from the time of acquisition, and had our first general availability offering of the product on a global basis in November 2013. So 2014 was the first year of product really being available in the market on an annual basis. That business closed 2014 at a $500 million run rate. Right, it will hit $1 billion this year. It's a shockingly fast-growing business because customers love it. It works, and it's built around a great team and a team that we are able to grow because of the continued talent that's available.
Oh, that's great. So, all of you have been hearing about the IPO window that is open right now. You know, some of those window periods have become famous and some infamous. Actually, I saw a chart that shows that when there is a window, the U.S. IPOs go like this, and the Israeli IPOs go like this. And when the window closes, Israeli IPOs go down the toilet, and it's much more of a sharper graph than the American ones. So how does this window, the opening of this window, and all the IPOs being done, impacting investing in Israeli companies or buying Israeli companies? Is there a direct correlation between the window being open now and the IPO activity and what you would otherwise do? Steve, what do you see among your clients?
Well, I guess, I caveat to say that there were about 150 IPOs in the U.S. last year, and I think we heard from our speaker, John, who kicked off yesterday's session, that there were approximately 20 Israeli companies in that 150. And I think if you look at the attributes of what it takes to go public in the U.S. on NASDAQ or the New York Stock Exchange, the companies by and large have raised upwards of $100 million of venture capital. And their revenue, I think the median revenue is over 140 million. So translated, that takes 7, 8, 9, 10 years. So if you look at Matt's example of Extreme.io, that company was probably less than 3 years old. It had 45 people, and it exited. So I guess my takeaway is, one, it takes a lot of patience. You never know when the IPO window is going to be open, but you have to build the company, if that's your goal, to be ready when it is.
Yeah, I would just make another comment. I think that there's a very sound and robust VC investing community in Israel that is ready to fund companies to some level of growth, and then those investors will expect either an IPO or a sale. What's still lacking in Israel, in my opinion, and I'm not quite sure why, is something that's developed quite rapidly in the U.S. in the last couple of years, and it's the growth equity financing or the private equity financing that's happening with late stage startup companies, but companies that are somewhere between $50 and $150 million of revenue and are getting very high valuation, very high financing rounds to take them to, the point of development that typically an IPO would otherwise take them to. And I don't know why there aren't more examples in Israel of that growth equity, of that PE financing round, late stage investment happening.
Well, are Israeli companies exiting too early? Even though the average deal size has increased exponentially, it's still relatively low to international standards.
Again, my perspective, and I've been working with entrepreneurs for 30 years, is it really takes a vision of the CEO and the founding team. It takes a passion, it takes a relentless pursuit of a goal of building, an enterprise, a company, and not just selling it. I mean, an entrepreneur told me 20 years ago, he called it the pie theory. Do you want to own a big piece of a little pie, or do you want to own a small piece of a big pie? And that's an IPO, because on an IPO, founders own less than 20% of the company, typically. But when you have an exit of a 3-year-old company, like an Extremo, Founders usually own over 50%.
Yeah, and on a risk-adjusted basis, it may, right, the calculus may just be that much easier to make.
Well, now you have a whole bunch of new Israeli companies, new publicly traded Israeli companies. What will it take to sustain themselves as a viable business going forward, as opposed to a company that is just geared to being acquired in the short term?
Well, so I'll give my view. I don't think that the challenges that young Israeli, newly public companies face are so dramatically different than the challenges that any newly public company faces, right? You have to expand your offering set, grow your public company infrastructure now to be able to meet your reporting and other requirements, and put in place both a management team and a board of directors that the street is going to respect, right? The nuance for Israeli companies, I think, is at least with the companies with which I am most familiar, is the boards of directors, the management teams tend to be heavily focused on Israelis. And that's not a bad thing, but I think as the companies want to grow into being recognized U.S. brands, they need to expand the management teams, expand the boards of directors, and expand the business accordingly.
So Steve, do you think Israeli companies that go public, say, the typical, $50 to $100 million IPO, do you think that they are doing that to create a global brand, or you think they're doing that so that 2 years from now they can sell themselves to a bigger company?
I mean, we had one in New England, a company called CyberArk, and if you look at, again, the typical IPO company, as Matt said, they've got management teams, they've got boards of directors, they've got the infrastructure you need first to get public and then to sustain being public. I mean, you need to sell, if you're a technology company, great technology will get you so far. But to build a company, I really think it's people, process, and systems. And if you get the right people, they put in the right processes, and they put in the right systems. You have to have infrastructure. You can't grow a company to $100 million and not have infrastructure. And I think that's what's needed. I think once a company goes public, then you, as a board of director, you have a fiduciary duty to possibly sell the company if EMC comes calling, or Cisco or Apple. But usually, if there's an alignment between the founders and the venture capitalists, which most venture capitalists are aligned with their entrepreneurs, and if the vision is IPO, then it's achievable if you kind of follow that recipe.
So let's go back to an earlier stage where you have a company that has some good technology, maybe 30 employees. It has a couple of beta sites, maybe a couple of Israeli customers. What will it take for a company like that to be the recipient of an investment from an EMC, or even being acquired by EMC? What are the positive attributes that they need to nurture? And let's also talk about the negative attributes. What will be turnoffs?
All right, well, I'll start just with respect to our investment practice. As I said, we start with strategically relevant technologies, right? And tend to focus our investments very heavily on areas that are of most importance to our current strategic objectives. We're also very focused on the team, the quality of the team, the track record of the team, the size of the significant, I guess I should say the number of the significant contributors to the company's technology, right? If there is one key contributor and a band of merry followers, we might be less inclined to sign on with the company than if there were several important contributors, a large team. I'll give you one example, just from EMC's recent past. We invested in a company called Scale.io, which had some very exciting technology for EMC, very disruptive technology, actually. The core founding team was 5 engineers, all of whom we thought very highly of. EMC invested. EMC ultimately acquired the business, and it's another tremendous success story for the company.
Steve, what would you advise a company at that stage What do they need to do right, and what do they need to avoid?
I guess the first thing that comes to mind is surround yourself with great people. You know, at the end of the day, I think technology is technology, but it's people that make it happen. It's people that will ultimately find the markets, find the customers that will build the company. So, you know, again, I think for entrepreneurs, you know, if you start off and you raise friends and family money and then you raise seed money, that's all great. But I think the entrepreneur that's able to raise venture capital gets a whole new perspective. You know, I think whether it's Israeli venture capitalists or U.S. venture capitalists who invest in Israel, it really, I don't think, matters. And I think as we were talking, again, one of the speakers yesterday mentioned that a new phenomenon in Israel is private equity. And, you know, I think at the end of the day, like I said, it takes about $100 million to build a company to over $150 million to take it public. So you got to figure out where you're going to get that money if you're going to build a big company. And I think it really does start with the management team.
I would agree with that. I think if I look back at the couple hundred startups that I've represented over the years, the single biggest differentiating factor between those that succeed and those that don't is the management team. So what advice would you give to an entrepreneur who's raising money for the first time, maybe institutional money for the first time, and you know, what does he or she need to do to become the person that you want to invest in terms of personal growth?
I'll start. So let's assume that you've got an interesting technology idea, what have you, and you have several potential investors lined up who are interested in helping you grow your business. I would focus very carefully on what it is you expect to get from each of those investors. From VCs, you'll get one set of capabilities and assistance. From corporate venture partners, you might get another kind. And from individual investors, you might get a third variety, perhaps more limited. I think at this point in which you are taking in institutional money, it is critical that you understand what that money is going to do for you. And it's not just the dollars, right? It's what is the infrastructure of the investor going to bring to your business going forward.
Yeah, I agree. Sometimes when I get to do workshops on term sheets, I ask the people, what's the single most important term in the term sheet? And my answer is always the name of the investor.
No, and it makes a difference, right? I mean, we look quite differently at companies with name brand, top-tier venture capitalists than we do with VCs or other investors with which we are just not familiar.
Yeah. Although that's not necessarily,
it's not necessarily bad.
Yeah, you can have very good VCs who you can get to know. Steve, any other words of wisdom for
Again, I mean, statistically, 80+% of companies in the technology space are going to get sold. Less than 20% are going to go public. Mm-hmm. So even if you look at the most successful venture capitalists on the planet, many of which are out in Silicon Valley, maybe 15 to 17 to 18% at Kleiner Perkins, Benchmark, Sequoia. So again, the odds are the company will not go public. But I would still submit that the companies that are going to get the most value are going to invest and build teams that have, the ability to scale, even if they don't go public.
Yeah. One attribute that I found in Israeli entrepreneurs that I haven't seen anywhere else in the world, and which I really admire, is the fact that they are not afraid to fail. Somebody can come to me and say, this is my 5th startup. And so I said, well, what happened to the other 4? He said, we went so far. And there's no shame in failing. It's great. You learn from your mistakes, you move on, and the more you've experienced, the better off you are. And I think I don't see that anywhere else in the world.
Yeah, I think it's one of the foundational traits of the innovation culture, right, that Jonathan was speaking about.
Great. All right, we have 27 seconds more. Steve, any last parting words? Matt?
Do you want to take questions?
Matt's looking for business plans, so.
Great. Well, I hope you enjoyed it. We'll stop 10 seconds before our time and let the next person start.